A few months ago, someone sent me their portfolio for a second opinion. On paper, it looked fine, diversified, professionally managed, all the right labels. So I asked him one simple question. If you stopped working tomorrow, would this portfolio support your life? He paused and then he said, very honestly, I don't know. And that pause, that uncertainty is the problem I want to solve today. Because most people aren't losing money, they are losing time. They are stuck in portfolios that look correct, sound correct, and are even professionally managed but don't really compound. And what I want to share with you is the operating system I have seen the best investors use. Not the loudest, not the most active, the ones who quietly build wealth and don't panic every cycle. And by the end, you'll have a practical way to audit your own portfolio without needing to become a financial expert. Now, here's what happens to a lot of high earners in the GCC. They do the hardest part. They earn well, they save, they stay disciplined, and then they outsource the investing part to a bank or a wealth manager. They get a portfolio that looks neat on a slide. Global equity funds, bond funds, maybe a few alternatives, maybe a few structure notes that were recommended. And for a while, it feels fine. But then there's a few years pass. And the person starts asking questions like, why does my money feel like it's not moving? Why do I feel anxious even though I am diversified? Why is my portfolio down 25% when I am supposedly balanced? Where exactly are my fees going? If I stop working tomorrow, can this portfolio actually support my lifestyle? And here's what I have noticed. They don't lack intelligence. They lack an operating system. Because investing is not about picking assets. It's about designing a system that behaves well when life happens. And life does happen, especially for affluent GCC expats. 1 year, everything looks stable. Next year, you're dealing with a big liquidity event like selling a business, vesting stock, or a property exit. A cross-border move that changes banking access, tax exposure, and account structure. A major portfolio concentration risk like too much real estate, too much company stock, or too much one currency. A large capital call or private deal opportunity that shows up fast. A credit or leverage decision like property leverage, Lombard lending, or refinancing at a very different rate environment. An unexpected market regime shift where the old 60-40 playbook simply doesn't behave as promised. And for many families, succession planning across jurisdictions where the wrong structure creates real risk. So if your portfolio is built like a textbook, but your life is not, you feel stuck. And here's what I realized after working with hundreds of investors in this region. The ones who build real wealth aren't doing more. They are doing different. They are operating with a system most people don't even know exists. I call it the investor operating system. Now, before we get into the operating system, I want to give you a simple mental model, the triangle. Every strong portfolio balances three forces. Outcome, what the money must do for your life. Downside, what you can realistically tolerate without breaking. Leaks, what silently drains compounding, like fees, taxes, and churning. Most people build portfolios by chasing returns. The best investors build portfolios by protecting this triangle. If you get these three right, almost everything becomes easier. Let me walk you through how I look at this. Stop buying portfolios, start designing outcomes. Most portfolios are built backward. They start with products. Like here's a balanced fund, here's a model portfolio, here's a recommended allocation, and then they try to force your life to fit inside it. But the real process is just the opposite. You start with your outcome because there are only a handful of real outcomes investors want. Income, whether it's monthly or quarterly cash flow, growth with boundaries, controlled downside, capital preservation, you can't afford a large drawdown. Liquidity and optionality, cash ready for opportunities. Legacy planning, multi-generational, low drama, currency alignment. Your life is in AED, USD, GBP, INR, etc. Most people mix all these outcomes inside one bucket and call it investing. That's why they feel confused. A very common GCC example. Someone says, I want growth. But what they actually mean is, I want growth, but I can't handle a 30 to 40% drawdown because I have school fees and family obligations and I don't want to work forever. That's not growth. That's growth with boundaries. Completely different design. So the empowered investor starts by answering, what is my money supposed to do in plain English? Because if you can't explain your outcome clearly, you will end up with a portfolio that is technically diversified but emotionally unstable. And emotional instability is the biggest destroyer of wealth. If you can't survive the bad years, you don't get the good years. I learned this early in my career watching 2008 unfold. People think wealth is built by being aggressive, but I have seen the opposite. Wealth is built by staying in the game, and you only stay in the game if your downside is controlled. Most investors don't lose long term because returns are slightly lower. They lose because of one or two moments. A big drawdown, a product they didn't understand, leverage at the wrong time, panic selling, freezing for years, then coming back after prices are already higher. So I have a simple rule. Your portfolio should be built to protect your behavior, not just your money. Because the biggest risk is not volatility. The biggest risk is what volatility makes you do. So ask yourself, if markets drop 30%, what happens to me? Do I sell? Do I lose sleep? Do I stop trusting the plan? If the answer is yes, your portfolio is not designed correctly. Compounding is fragile. Protect it from silent drains. Now, let us talk about something most people don't treat seriously enough. Leakage. Fees, taxes, unnecessary churn. Here's what people underestimate. Fees don't just reduce returns. Fees compound against you. Let me show you what this looks like in real life. Two investors both start with 1 million. Both earn 7% gross returns. Investor A pays 2% in total cost, fees, trading spreads. Investors B pays 0.5%. So net returns, investor A nets 5%, investor B nets 6.5%. After 20 years, investor A has about 2.65 million. Investor B has about 3.52 million. That 1.5 difference cost investor A roughly $870,000, almost the entire starting capital. Now, I'm not anti-fee. Good advice is worth paying for, but you must know what you are paying, why you are paying, and what you are getting. Here are the 4 leaks I see mostly in GCC portfolios. Leak 1 is the layered fees. It's not just one person management fee. It's also platform costs, fund expense ratios, transaction cost, currency conversion spreads, product embedded costs, sometimes hidden in pricing. Leak 2 is unnecessary activity. Too much trading disguised as active management. Leak 3 is tax blindness. Even if you live in a tax-friendly environment, your investment might not. Withholding taxes, cross-border structures, they matter. Leak 4 is complexity premium. The more complicated the structure, the more places money can leak, and the harder it is to audit. Your returns are shaped by your information diet. I noticed something in Switzerland with wealthy families. They weren't necessarily smarter, but their information was cleaner. They weren't reacting to headlines. They operated with better industry context, better cycle awareness, better filters, and better advisors who help them think. Now compare that to how people invest today. Social media narratives, short-term news, random tips, performance chasing. Now that doesn't create wealth. It creates anxiety. So the empowered investor upgrades inputs. They ask, who influences my investment decisions? Are my inputs designed for attention or for accuracy? Do I have any inputs from people close to industries or just markets? Remember, high quality decisions rarely come from high speed content. Don't outsource understanding, build around your circle of competence. If you don't understand what you own, you don't own an investment. You own a story. I have sat across people with impressive portfolios, 20 funds, 10 themes, 5 geographies, and they can't tell me the engine of return. You don't need to be a finance expert, but you need a circle of competence. If you are in healthcare, you understand healthcare. If you are in logistics, you understand supply chains. If you are a business owner, you understand pricing power and cash flow. Edge doesn't mean blind concentration. Edge means your portfolio has a core you can defend intellectually. Because when markets gets noisy, you don't panic. You understand, and understanding protects behavior. Timing isn't prediction. It's knowing when the risk is being paid. Most investors think timing means predicting tops and bottoms. That's not what I mean. Cycle awareness means knowing whether you are being paid for risk or taking risk for free. A simple lens. When optimism is extreme, risk is often underpriced. When fear is extreme, risk is often overpriced. Most people do the opposite of what works. They become brave when markets are expensive. They become cautious when markets are cheap. Empowered investors don't predict. They observe. They ask, are valuations stretched or reasonable? Is credit loose or tight? Is volatility cheap or expensive? Are people acting with discipline or FOMO? And then they adjust risk accordingly. Not aggressively, calmly. Cash isn't lazy, it's strategic freedom. Liquidity in the GCC is not just emergency money. Liquidity is freedom. Because this region has a different rhythm. Business opportunities appear fast. Relocations happen. Big family obligations arise. Property decisions come. Cycles shift. Liquidity lets you act without stress. It also lets you buy when others are forced to sell. Sophisticated investors keep a portion of liquidity not because they are scared, but because they respect optionality. Optionality means when the world offers you a mispriced opportunity, you're not begging your portfolio to cooperate. You are ready. Now, where do structured notes fit into this operating system? The structured notes are not a magic product. They are a tool, and when used correctly, they can express several dials well. The outcome design with income, buffered growth, defined payoff, downside first, barriers, buffers, conditional protection, leakage control, clearer structure, often less ongoing churn, cycle awareness, you can structure for volatility regimes, optionality, coupon structures can keep cash flow steadier in uncertain markets. But they are not for everyone. They require understanding payoff conditions, issuer credit exposure, what protection actually means, proper sizing in the full portfolio. My stance is simple. If structure note fits your outcome and your temperament, they can be powerful. If they don't, you should never force them because the operating system is bigger than the product. The product is just one expression of the operating system. Let me give you a composite example. No names, but a very real pattern. A senior professional in Dubai. Net worth is split like this. Large portion in property, some cash and deposits, and the rest in a balanced portfolio with a private bank. On paper, he looked fine, but emotionally, he's anxious. Before we worked together, he told me, I check my portfolio every week, and every time I check, I feel anxious, even when it's up. That line stuck with me because that's what a lot of people experience. Not a money problem, a system problem. So we did not start with products. We started with outcomes. Step 1 is define outcomes as buckets. Income bucket, growth with boundaries bucket, liquidity or optionality bucket, long-term legacy bucket. Step 2 is set downside rules. No single bucket should have a drawdown that makes him abandon the plan. Step 3 is reduce leakage. Consolidate where it makes sense, audit failures, reduce unnecessary activity, simplify. Step 4 is improve inputs. Less reaction, more intentional reviews, better questions. Step 5, use tools appropriately. Maybe that includes high quality fixed income for stability, disciplined equity exposure, selectively designed structure notes for defined outcomes, and a deliberate liquidity reserve. And after we rebuilt the system, he told me something very different. I check it once a quarter now and I sleep better. That's the difference between a pile of investments and an operating system. Now, here are 5 questions I use to audit any portfolio in 5 minutes. What is this portfolio designed to do? If the answer is vague, that's your first problem. What is the realistic downside in a bad year? Not theoretical, but realistically. What are the leaks? Total cost, not just one visible fee. Do I understand what I own well enough to hold it in stress? If no, you're likely to sell at the wrong time. Do I have optionality? If the world offers me an opportunity, can I act calmly? If you can answer these 5 questions clearly, you are ahead of most investors already. The empowered investor is not the person with the fanciest products. It's the person with the cleanest operating system. They design outcomes. They control the downside. They stop leaks. They improve inputs. They invest inside their competence. They respect cycles and they keep optionality. And once you think this way, investing stops being stressful. It becomes boring, and boring is good because boring is what compounds. Now, if you want to go deeper in any of these dials, if you want to see how this applies to your specific situation, or if you want to audit your current portfolio using this framework, my contact information is in the description. But whether you reach out or not, I hope this gives you a clearer lens, because better questions create better outcomes. And once you start asking better questions, you're already playing a different game. Thanks for watching. I'll see you in the next one.